if I ask you to kind of foresee, and I know it's a difficult thing to do in such scenario, but still, there's some bit of a correction in prices, even though there might be an uptick. At the same time, there's a correction in the input costs as well, and therefore the spreads, so on and so forth, and realization versus spreads. How do you think the next couple of quarters shape up? I would ask you for the year because it's too long a time frame in these circumstances, I guess.
Yeah. So Neeraj, I'll explain it this way. Traditionally the carbon cost, energy cost was 10% of our raw material cost. Let me put it that way. So when you look at spreads, you look at iron ore and coal, and you look at steel price, and you look at the spread, right? So gas and carbon costs were, let's say, 10 to 20% of the raw material costs, and hence were not really material as far as the spread calculation is concerned. Over the last 2-3 quarters, it went up to 40%. So even if the spread looked good, a lot of it went away in paying gas prices, energy costs, carbon costs, etc. Today, it's come back to that 10 to 20% level. So it's back to where it was before. So we are no longer looking at the spreads not flowing through to the P&L because of this, right? So that is, to me, one way for us to explain it. Second way to explain it is, if I look at this whole year, we would have spent at least 100 million euros more than we would have normally done on energy and gas. Okay, this is despite some support coming from governments. This is despite some hedging being done by us, because we used to always hedge gas prices going forward. So we did not get hit by the worst, but still we have spent 100 million, and 100 million is a lot of money for us in the European business, right? So these are things that we will not have next year, right? So if we go back to coking coal prices and iron ore prices, they will also drop, because they had gone up to $600, right? So today coking coal is maybe around $340. It had gone down to $250, but it's also reflecting the recovery in China. Iron ore, which had gone down to $90, is back to about $120. So we always expect iron ore to be in the $110 to $140 range. Coking coal, normally we would expect to be around $300 on an average, unless there are spikes, there are weather events in Australia, or the kind of event which happened in Ukraine.
Got it. So just wondering, do you see some of these benefits of the cost savings being back-ended if I take the calendar into consideration, or could it be evenly spread out? Just thinking
so there are two things, Neeraj, here. One is a cost situation will keep getting better in Europe, like I said, because gas and energy will come back to long-term levels. Coking coal will go up and down, but a little bit of volatility we are used to handling. So I think it will be stable in that range, maybe $250 to $350 range. Iron ore will be in the $110 to $140 range. We are waiting to see whether the demand picks up, and demand could pick up if China opens up, because Europe exports a lot into China, particularly large economies like Germany, Italy, etc. Right? So that is something we are watching. On the revenue side, the spot prices will go up, but the long-term contract prices, which we just negotiated for this year, will be lower than last year, because last year's negotiations happened last year in January, and most of the long-term contracts were over 1,000 euros a ton. This time it will be maybe 850 euros a ton or whatever. It will still be higher than the spot prices, but lower than last year's long-term contract prices. So we see a mix of this. For us, we also have a blast furnace relining coming up in Netherlands next year. So for 4 months, one of our blast furnaces will be down. But that's one of the reasons why we build stocks, so that we don't lose much sales, even though one of the blast furnaces will be down. So we are going to have a challenging, like I said, the worst is behind us from, as I described, last quarter. But we will still have a challenging quarter this quarter and the next quarter because of the blast furnace shutdown. But after that, we hope to get back to what we see as long-term performance levels.